Hello, my name is Keith Harmon from the law offices of Andrews and Harmon, and this is buy-sell agreements for agents. This is just a brief overview of buy-sell agreements in California. So the major points I'll be talking about today are what is a buy-sell agreement, why business owners should use a buy-sell agreement, how to fund a buy-sell agreement, questions to open the door to get this discussion going, and then buy-sell agreements for sole proprietors, partners, and corporations. So first off, what is a buy-sell agreement? A buy-sell agreement is a powerful tool to help business owners control the future of their business. It's a contractual agreement between the shareholders, partners, or even the sole proprietor and a key man, and it helps, again, dictate how the business is going to be ran if something were to happen to the partner or shareholder if a triggering event occurs. And by triggering event, I mean death, disability, termination, or retirement. So second major point, why business owners should use a buy-sell agreement. Well, first again, it's to control who gets into the business. Generally, a lot of partnerships or in a corporation, the shareholders don't want to allow the spouse of one of the shareholders to come into the business and dictate how it's going to be ran if something were to happen to that shareholder. And this buy-sell agreement will be able to give the business owners an opportunity to control who gets into the business if something does happen to one of the partners or shareholders. You also want fairness for the surviving spouse and partner. By fairness, I mean upon death, disability, or dissolution of the business. Fairness will give them a fair market value for their part of the business. You want to make sure if one of them does retire or if they pass away, the surviving spouse can get a fair market value for the partner's percentage of the business. You want to make sure that they're getting taken care of as well. You also want a smooth transition. By smooth transition, I mean if something were to happen to one of the partners, that the partnership can continue, bring in new talent, and also give money to the surviving spouse for her interest, and the business can continue as it had beforehand. For agents as well, this is a great type of policy to sell because the commissions for these type of policies are generally from 80 to 100%. So you're doing a great service for yourself and then also for your business owners. So third major point, we generally use insurance to fund a buy-sell agreement. It really is the best tool for this type of agreement because it develops money in two different ways. The first way is it creates cash value in the whole life insurance policy, so they're able to put money away into the whole life insurance policy, but it also gives them a face amount if death were to occur for one of the owners. So it gives them a tool that builds cash in two different ways. So it's an awesome tool for them to use. Secondly, the company may need to be valued to know how much insurance to buy for the partners, but generally you can do that afterwards. Get enough insurance at least beforehand, make sure that they're covered, and then we can work on the buy-sell agreement after that point. The entity or the surviving spouse receives life proceeds upon the death or disability of the partner. So again, it's a great way to fund the buy-sell agreement. Fourth section, questions to open the door. And this is for the agents who are talking to their business owners, not sure how to get into the buy-sell agreement discussion. You can use these questions to just get the topic going. So first question, do you have an exit strategy? Most business owners have discussed or thought about their exit strategy. They may not have implemented anything, so they need to kind of get that going, and you can be the one to help them do that. Second major question, is it in writing? They may have thought about it, bought the life insurance before, but they need to have an agreement in writing. I say that only because if something were to happen to one of the partners and the life insurance policy paid off to the other partner, you want them to be forced to put money towards the surviving spouse for the interest of the other partner. You don't want them just to close up shop and take the life proceeds and leave the business. Third question, have you determined the value of your business? They may have gotten a policy before and thought they had funded their buy-sell agreement and may not have enough insurance in it now. It could have been 5 years ago the business was worth $1 million. Now it's worth $10 million. They need to reevaluate that potentially get more life insurance, and you can be the person to help them do that. And the last question is, how is your exit strategy funded? They may just be planning on just having the buy-sell agreement, but may not have actually funded the buy-sell agreement. So they need to make sure that they have enough insurance in place to help fund it. And again, you could be the agent to help them do stuff. So this section, buy-sell agreements for sole proprietors. Upon death of the sole proprietor, the business itself ends. Without a will provision to the contrary, the executor is going to be bound to discontinue the business and sell all the business assets and put that into the estate. So they need to have a buy-sell agreement or something in place to help them continue the business if the sole proprietor does pass away. So I do have an example for you. Owner A owns a business. He's married, and he has one key employee named B. Key employee B would like to buy the business from owner A upon his death, and they don't have a buy-sell agreement. If that were to occur, again, the executor is required to sell the assets of the company and put it into the estate. If they do have a buy-sell agreement, B can purchase the company from the surviving spouse, give her the death benefits at that point, and then continue the business without owner A. And the business would, again, continue, and they'd be able to keep their lifestyles going. Alright, so fifth subject, buy-sell agreements for partnerships. Generally use a cross-purchase for this type of buy-sell, and a cross-purchase is a fairly easy to understand type of buy-sell. The purchaser of the insurance is the individual partners, and they buy a policy on each other partner. That can sound a little confusing, but if you only have two partners, you have one partner buying a policy on his partner in the business, and vice versa. So it's only two policies. The beneficiaries of those policies is the owner buying the policy. Let's see. The agreement will make sure that the deceased partner will pay off the surviving spouse, and then they'll take over the business after the passing away. The disadvantages of this type of policy is that it can be disproportionate costs for the different owners. And by that I mean if you have a 60-year-old partner with a 30-year-old, the difference in cost for the life insurance can be great. So there's other ways we can look at it, but at least they need to get something going for themselves. And also it can be a disadvantage if there are many partners. If there's 8 or 9 and they're all trying to buy a policy on each other partner, if there's 8, you're going to have one partner buying 7 policies and then the next partner buying 7 more. It's a lot of policies, but there are ways around that as well. The advantages of this type of agreement is it's fairly easy to understand. One partner buying it on the other. Secondly, well-funded buy-sell, the families and the business are protected, so it's a great tool for that. And then corporations' creditors cannot reach the life proceeds in a cross-purchase. That's because you have two partners. This partner passes away, the other partner is getting the life proceeds. It's not the corporation getting it, so the corporation's creditors cannot get the proceeds of the policy. So second example, owner A is back again, but now he's partnered with owner B and they have a business together. Both are married, neither of their spouses are well versed in the business, and A and B want an agreement that if something were to happen to either of them, it'll protect the business but also protect the family of the deceased. In this situation, without a buy-sell agreement, the partnership is required by law to discontinue business, sell the assets, and then give half those assets to the surviving spouse. With a buy-sell agreement, the partnership can continue after the passing of one of the partners, and the proceeds will be given to the surviving spouse for her interest in the company. With that, the business can continue, and if you have enough insurance in there, it won't only just pay off the surviving spouse, but it'll bring in income and let the surviving partner bring in new talent to continue the business the way it had operated before. So the last section, stock redemptions or stock redemption buy sell. This type of policy, the insurance is purchased by the corporation itself. What you do this for is to minimize the amount of policies purchased. If there's 8 shareholders, then there's only 8 policies purchased. The beneficiary of this type of policy is also the corporation. So again, it's a great tool, helps really minimize the amount of policies purchased. The agreement is at the death of one of the owners, stock will be redeemed pro rata for the corporation. It will go out to the other shareholders. Advantages of this type of policy is the number of policies, like I said, is greatly minimized. The shareholders' percentage of ownership is increased by the amount of their ownership redeemed pro rata. And then insurance is also a cash asset for the corporation. If they have enough cash value in the policy or the death proceeds, again, it's a cash asset they can use towards purchase of any new material or tools for the business. Disadvantages is that the corporation's creditors can potentially reach the proceeds or the cash value of the life insurance policy. So they got to make sure that that's something that they're aware of. Alright, so last example, owner A and owner B are back again, and they own a closely held corporation. Both are married, and neither of their spouses are well versed in the business. Again, they want an agreement to protect themselves if something were to happen. Without a buy-sell agreement, the spouse of the deceased shareholder will take possession of the stock and will have certain rights to the corporation at that point. Most likely, this is not what the corporation was looking to do. With a buy-sell agreement, the corporation can continue to operate with the current management, and the insurance policy will afford them the ability to bring in new talent to help the business continue at the level it was before the death of that shareholder. And then my last section is if you're an insurance agent, again, the commission levels are at least 80 to 100%. So it's a great tool for your business owners and a great tool for you to help you increase sales. Again, my name is Keith Harmon. If you have any questions on this, you can reach me at 714-262-0798, or you can reach me by email at kph@richardandrews.com. Thank you so much and have a great day.